ideas for this year and beyond. Nitin, it's your first time on ET now, at least the first time we are interacting on this forum. So a very warm welcome and thank you for joining us. How worried are you about what is happening on the macro front? Oil is moving higher, bond yields are at a multi-month high. So the basic premise of this bull market, is it getting challenged? The basic premise of this bull market was oil will remain low for a long period of time and yields will remain compressed forever.
Hi, good morning. Thank you for the warm welcome. Overall, look, we think that macro economy wise, even pre-COVID, there's been a bit of a disconnect between the markets and the economy. As the year has gone by, several parts of economy have done well. Corporate India has used this pandemic as an opportunity to grow faster, gain market share. In addition, many of them have been able to reduce cost and improve profit margins significantly, right? And this is getting reflected in the capital markets where a large number of companies are trading at all-time highs. At the same time, there's lots of cheap capital that's been available because of the liquidity unleashed by the US and European central banks, and the low yields are forcing investors to increase their allocation towards emerging markets. Overall, geopolitically as well, what we see is that the new US administration is in place. It seems more stable, and hopefully the trade war rhetoric will slowly fade away, and there will be sort of stable global supply chain. And lastly, and most importantly, perhaps the biggest factor today that gives us all hope for a more stable future is the vaccine, right? Today, when I look at the next 1 or 2 years, we are experiencing one of the largest vaccination drive globally, and I'm optimistic that a wider vaccine rollout will usher in the end of pandemic, which will significantly bode well for consumption overall. While crude oil has been sort of slowly picking up and increasing over the last couple of months, and that does have macro effects on the economy because as a country which imports 86% of crude usage, we are dependent on crude in a significant way. Some of this is somewhat expected given that the crude oil prices were significantly depressed. We believe that as the sort of economy and the supply chains globally stabilize, the crude oil prices will also stabilize and support India in its growth as well.
Okay, now I completely agree with the scenario which you've painted, but some would argue that that's a consensus scenario, which is that earnings have bottomed out, interest rates are low, and it's time to focus on micro, not macro. So how much of the template what we've discussed is already in the price? Like they say in the market that markets always look forward. So markets have moved in anticipation of earnings. This year and next year when earnings come, have markets already baked that in?
Look, you can't argue that the market hasn't run up, right? So obviously the run up has been phenomenal and quite unexpected in several ways. And to some extent, a lot of it is priced in. So I don't think that the kind of growth you've seen from the March lows is something we can expect year on year on consistent basis. Having said that, what I really like to focus on is that there is a significant shift because of this pandemic from the unorganized to organized, and that is where a lot of the large companies which the market is composed of have done significantly better. And they will continue to do better. They've gained more market share. They've reduced their costs. It's sort of been a jolt where they've sort of reduced their costs significantly and improved their sustainability. So to some extent, I agree with you that this sort of euphoric run won't sort of keep happening year on year over time. But then this is going to be a market of sort of stock pickers, right? Some sectors, some areas where there has been a lot of support in terms of government incentives, government policy, and overall sort of disruptions and change in consumer behavior, they will continue to grow well at a measured rate of 15, 20, 25% year on year.
Sure. Okay. Nitin, let's talk about companies now and, pockets of opportunity, where perhaps you're focusing your attention. Some that have pivoted, survived, business models that have really proven themselves through this difficult period as well in terms of how they've operated, how they've leveraged the pandemic impact as well. What to you is appearing as the most opportunistic segment going forward?
So in terms of, just to give a brief about Paragon, right? So we are a private equity fund focused on investing into mid and small sized companies. We look to invest into high caliber founders and management teams who can grow their businesses 25 to 30% CAGR over our investment period, which is typically 4 to 5 years. We are long-term and patient capital. Apart from capital, given our team's operating and entrepreneurial experience, we work alongside our entrepreneurs to help them grow faster. We launched our first fund in 2015, which was about 760 crores, and we've made 8 investments out of it across consumer, financial services, manufacturing, and infrastructure services. We've just started raising the second fund with a target size of 1,500 crores. Out of the second fund, we have made 2 investments so far. The first company is announced publicly. It's called Tender Cuts, which is an omni-channel meat brand. Second company is not yet announced. It's a tech-led express logistics player catering to e-commerce sectors. Coming to your questions on opportunities where we see in our investment sort of landscape, we will look to invest 60 to 100 crores, mostly in MSMEs, companies with broad range of 100 to 500 crore sales. Today, in that sort of range, the number of companies that qualify that criteria must be more than 10,000, right? So we have an ample sort of base of companies to choose from and pick from. And there are not that many funds that operate in our space where they invest 60 to 100 crores. There are a lot of funds in the smaller ticket range up to 30 crores, lots of early stage PE and VC funds. And then there are very large funds who invest more than 200 crores in companies. These are large Indian and global private equity funds. So we've seen a very, very vibrant year in terms of the deal flow. In terms of our investment focus, we like to focus on consumer, discretionary, financial services, industrial, manufacturing, and healthcare as the key sectors. And these sectors are the ones where, and especially the ones which are backed by technology as a role, which plays a role of an enabler, is something that we really like. Some of the subsectors that we are studying very closely and will make our Fund 2 portfolio will comprise of them in a significant way would be beauty and personal care products, packaged foods, education technology, general insurance, apart from the traditional financial services. If you look at during the pandemic time, several stay-at-home themes have played out well in general, right? So the consumers have spent record amount of money buying food, staples, pharma, home improvements, consumer durables, laptops, etc. And as the vaccine is successful over the next 12 months, I expect there will be a massive surge in consumption. As a country, we've been sort of bottled up for a long time, and I'm sure that vast majority of people are waiting to go out and spend the money on travel and entertainment like never before. So I think that theme will also play out, assuming that the vaccine science works and is able to control the pandemic in a significant manner. And financial services is a sort of a core pillar for us to look at. We invest in NBFCs. Typically, we don't look at large ticket size loans such as real estate or corporate loans. We look at a very sort of small ticket size, 3 to 5 lakh loans in personal loans or small SME loans. And these loans are sort of a large unmet need because lots of banks find it difficult to serve these sort of customers, and we believe that this vintage of NBFCs, the kind of companies who have remained successful so far this year, remained resilient this year, will have a significant advantage to grow in this vintage. Certainly won't necessarily be the ones who grow the fastest, but the ones who focused on efficient collections and managed to keep strong control on operating cost and good asset quality.
Okay, that's a nice elaborate description of what you're perhaps watching out for as well. On current deals in particular and what's in the offing, AI, tech, of course, that's where a lot of attention continues to be. What about your own deal activity? Any indicators you can give us in terms of what's brewing or what you're looking at currently?
So the last deal that we just announced is called Tender Carts. It's a omni-channel branded retailer that serves fresh chicken, mutton, seafood, and this is a perfect example of the theme that I was talking about, right? So you have to understand that 90% of the meat retailing, more than 90%, is largely unorganized, which means it's unhygienic, full of hormones, dependent on a series of middlemen. Whereas Tender Carts offers healthy, hygienic, hormone-free, antibiotic-free, freshly cut meat and seafood. We believe that there is significant opportunity for a company like that to leverage its supply chain of farmers and fishermen and its omni-channel strategy to efficiently sort of cater to mass market at prices which are not that much higher than the unorganized wet market. Overall, the company like this, in terms of to fulfill omni-channel, is not trivial, right? Overall, as the rising sort of digital penetration and affordable access to data, customers demand convenience and flexibility to buy products and services through online and offline medium. So from customers' perspective, online and offline are the two sides of the same coin, and they may come across an ad on Instagram and look up a product on company's website, then use mobile app to make the purchase and expect the product to be delivered to their doorstep from a neighborhood store, right? So there's a significant sort of interplay between online and offline. A successful omni-channel strategy requires a very integrated supply chain, inventory transparency across different channels, a technology footprint to facilitate that execution, and then a good mix of alignment between marketing and supply chain. Overall, we believe that technology, AI, ML, those are very, very important aspects of companies that we are looking at today, perhaps more so in the last 12 months. So even a small company like Tender Carts, they are using predictive analytics to predict the demand, considering it's a perishable product. You have to get inventory right, otherwise your wastages can eat into your profit margin significantly. There's lots of technology which we are using to make sure that the operations are more efficient. Similarly, our second investment, which is a tech-led express supply chain company, it's basically caters to e-commerce industry, which has been growing at 40 to 50% year on year, and even some of the large players are growing faster with a large base. COVID has provided a fillip to the industry where the daily shipments have increased about 50% in the last year. Overall, we believe that the technology, and again here, technology is very important, right? Because they use lots of technology, because the asset base or the trucks they use are not all their own. There's an asset hybrid approach. So to be able to deliver a high quality service level from a vendor and make sure that the progress of the trip and the tracking of the trip and the efficiency of the trip is as good as your own truck requires a lot of technology, interface, and analytics to make sure that the companies are not unhappy about receiving a truck from a vendor. So we believe that this sort of vintage of investments will all have a significant root in technology and AI and ML. And many of the companies who adopt it quickly and use it as a core operation rather than an add-on will significantly overperform companies which choose to remain brick and mortar and slow adopters.
Sure. Niten, just wondering, what is the best way to directly or indirectly invest in India's evergreen theme, which has been consumption, the uptick on, demographics, per capita income going higher? Or would you say the entire thesis gets challenged because of the uptick in inflation on account of not just fuel, but agri-commodities too?
Yeah, so that's a good question, because consumption overall, if you look at the last couple of decades, has been driven by some of the large cap consumer companies which are listed. What you see in the last few years is many of the small companies coming in, offering a much better product or services, and be able to engage as a brand with the consumer more intimately, and that is what we are seeing sort of play out in a significant manner, right? So when a typical consumer looks to purchase, they want to buy products that they can connect to. They want to buy products of the brand where the brand speaks to them, and then there is a healthy sort of exchange between the two. And this is something which is a bit unsustainable for very large companies to do, given their own structures and the wide distribution. And many of these consumer companies, we've seen some of these examples where some new age consumer companies have been getting acquired by large companies because they have managed to crack the consumer delight, and they've managed to create a niche offering in a very crowded market. I think the inflation, the food inflation and the agri-inflation is playing a small role in throwing a dent, but many of these consumers today are not just price and value conscious consumers. They want to be seen with a certain brand. They want to be able to talk about the brands they're using and the new products they're embracing in a significant way with their family, with their friends, post it on Instagram. And we're seeing a lot of these young brands doing excellent work in various different segments, in apparel and retail, in food, beverages, in consumer packaged products. Overall, we believe that consumer, as a consumer discretionary as a sector, will continue to grow well. And a lot of these other parts of consumer which have been under pressure due to COVID pandemic will come back very strongly once we are over the vaccine hump.
Sure. Also wanted to understand, besides consumption as a category, we often talk about what to buy, but I want to ask you, what is it that you would not buy in this market, either because of the valuations or because of the business or because of the environment, like we just talked about with regards to consumption?
So obviously, as a fund, we don't look to invest in asset-heavy businesses which require a lot of capex and many years of sort of building that, and that's a sort of area which we would not look at. Offline retail, travel, hospitality, they've all been areas which have struggled in the last 1 year, which I hope will bounce back in the coming years. In a country that is growing at such a high pace compared to the rest of the world, it's hard to see a significant pocket of underperformance as such, right? So the way I would look at it is from where we are, I would be wary of investing in businesses where the founder and the management team don't have the mindset of technology and don't have a data-led decision-making and data-led thought process. We believe that technology has moved from a nice-to-have to a must-have. And then also in terms of corporate governance, we will look at companies with impeccable corporate governance. And obviously what's also important in a market like this, it's easy to see the stock market climb up and pay high multiples. But we believe that prudent entry valuation and disciplined approach to entry is quite valuable, and sort of not forget the basics of investing at this point, because I see a lot of, in some ways, FOMO in investors' mindset, where they feel like they've missed a significant part of this run.
Where are you looking at exiting? Because you made investments in the past. The idea is that you invest for next 2 to 3 years. That's what I can understand from your conversations. Where do you think that the pie has got baked?
So out of our 8 investments in Fund 1, we're a 5-year-old fund, right? So the first investment we've made is 5 years. Our typical holding period is 4 to 5 years. So last year, if things were better, we would have started to exit from some of our initial investments. We have one investment in a publicly listed company. It was private when we invested, and then it went public, called Capacite Infra. We partially exited from a position a couple of years ago, and we still have a significant stake left. We will look to exit as per the sort of exit timelines of the company for the fund. Sorry. Other companies that we look at, there are lots of interesting opportunities cropping up in the last few months, right? So there are companies in automotive and aerospace area where there's lots of interest in raising additional capital. Our consumer companies, which had taken hit during COVID, have bounced back significantly, and most of them are above the pre-COVID levels now. And this is the time where we want to use this year to sort of make up for last year's dip, grow over the 2020 numbers, and then look to exit at the right sort of time. So we expect that the next couple of years we will see lots of exit from our Fund 1, and then sort of distribute that capital to our investors.
Thank you for joining.